And welcome to today's follow-up video. I told you that non-farm payrolls would be stunning the markets, and they turned out so. So how did I turn exactly the challenge of a preceding scenario not being met by actual figures into a clear winner multiple times of what was bad in the first instance for clients? So let's dive into it, how to be winning on stunning non-farm payrolls. You know pretty well what I do for you all and how to take best advantage of it in real time, because that's what had paid for you, especially today. For all clients, whether you are swing or intraday, you are in the picture what I expect as the price path for S&P 500 and Nasdaq today. And given what has happened, you pretty well know what is in store for Russell 2000. So this is the before that I had discussed. I was looking for decent figures and I was not looking for private payrolls to disappoint. And boy and girl, they did not disappoint. It was a stark upside surprise. No matter that manufacturing and government payrolls, as you can see from this follow-up figure, had been coming on the not so stellar side of things. I advised you to pay close attention to University of Michigan data as well, and they had just added to the risk of sentiment that grabbed the markets, and the first rebound that we sold into, that was followed by more downside, and this University of Michigan set of data quite sealed the fate, and we are of course seeing violent intraday rallies and declines as well. And clients of course know what I expect as today's price and how it fits into the larger picture of S&P 500. As for the University of Michigan data, see that the consumer confidence has declined, which is not optimal, and as well that inflation expectations have risen, and given by how much they have risen, these have had a solidly contributing effect to way less of Fed cutting expectations. Now we are at probably October as being the first cut after we saw odds receding steadily through March. Now, quick set of charts. Do you believe in a rebound and trend reversal in S&P 500 here? You see a 4-hour chart that is quite oversold, but not yet wildly oversold. RSI is only at 30, MACD histogram is still pulling lower, and the chart is quite under distribution. Compare, see the relative positions and how tempting it would be to say, oh, this is support and it held. The sky is clear and you can go swimming with the sharks again. Sure. It would be tempting to say that Nasdaq is leading higher, but yeah, Nasdaq would catch some bait in the environment of rising rates or shifting daily expectations of the rates path, which is what we had seen today. So I would not overestimate and not read too much into it. I consider Nasdaq to be somewhat cushioning on a daily basis another stark hit to market breadth that we would see following the closing data. And the final, well, it's not winning an Oscar, but still it's another chart for our chart under heavy distribution is the Russell 2000. And as you can probably guess, I'm not expecting any kind of reversal in the major indices today. Volatile trading, sure, yeah, but nothing of the kind of Wednesday when we were fearing about Fed minutes being too bad and then relieved. It's not been that bad as expected, which is quite frankly similar stuff that had been played a few times already last year around the Beige Book and other Fed macroeconomic assessments or events or pronouncements that have caught the market off guard and sought to reinforce recent shift in expectations narratives. And that's what I had been covering for clients this week mostly, but there had been a noticeable shift for a good couple of weeks when I had been pushing the idea that yields are going to rise, keep rising, and we might at best might, but that's not been the case, as the beginning of this week showed, and as I had written, a brief counter-trend move in yields, and instead we are seeing them push higher, and this Russell 2000 chart very nicely reflects that. So that's exactly what we are seeing, strengthening dollar, and once we get Bitcoin breaking down below 92,000, it will be a sight to behold. There is of course way more to cover on the market shifts. Some predictions work better than others, and today predictions for trading signals clients worked much better when I called for gold to shake off reasonably fast, quite fast, saying that it would be really insightful and just a confirmation of recently found, newly found, again found relative strength. And it took well less than an hour for gold to turn green again, and for some time it looked as well that crude oil was barely touched, and now it started to wobble a little, but I do not think that this is the final rejection of oil in oil. We are seeing quite some shift in real assets unfolding. What started with agri-foods is slowly spreading and circling back to University of Michigan inflation expectations. It's important what the market does. Hence, as you saw me tweet, it does not matter what I think going into the data. It might, thanks to my macroeconomic background and experience, turn out well. Most of the time it turns out well, but what counts is the market reaction. And if the initial expectation of prices and S&P 500 being a bit gobbled up and supports holding and not cracking immediately on the data, if it fails, it's so important to read the data correctly, go with the flow, and have a plan. And the plan that I have introduced first to paying clients, be speed swing or intraday was about volatile session with heavy downswing bias and daily close way not too far from the intraday lows, wherever these may materialize. The day is not over. Apart from the opening hour and final hour, the daily volume is lighter, so that makes for quite a few volatile 30 minute or hourly candles, and that's why we can expect ups and downs, but nothing of the sort of what we saw on Wednesday. So ask yourselves, running back to this S&P 500 chart or revisiting this Nasdaq one, whether you see a convincing rebound on decent volume or something what I call eating through supply, charts still on distribution and heavily challenged by macroeconomic and fundamental factors, because just as the October 2023 rally was triggered by expectation of 6 or 7 rate cuts, we got less than half, let's say it politely, and now how many cuts do you think we would get in 2025? We are in for another year of the US dollar and with everything what that means for asset prices. Violent upswings, violent downswings, who have been trading in the year 2016 remembers, and this is 2.0 on steroids, so welcome to the new administration that has not been yet sworn in. It will be a fun year ahead. Glad to be at your service. You know perfectly well what I do. Do yourself a favor and select a premium product so that you are kept in touch the single second I publish the premium thoughts to take advantage of these volatile moves, because this will be about quick turns, whether the bullish way or the bearish way. And right now you remember my opinions in November and December, both months, that I expect a very tricky January, February, and a particularly difficult period till the inauguration. So welcome to the fun, welcome to the party. You know my journey, you know the infographic and how much I esteem seeking justice where there is some justice to be found. Yeah. Obligatory disclaimer, and looking forward to talking to you again. Thanks for liking, subscribing, commenting.